it's time to talk about material non-public information, also known as insider trading. That is this section of the cheat sheet. Let's read what the Standards of Practice Handbook says for this particular one. Standard 1, 1A, Material Nonpublic Information. Members and candidates who possess material nonpublic information that could affect the value of an investment must not act or cause others to act on the information. That's it. Most important thing, if you ever get this information, do not move. So let's review a couple of terms here that you have in your glossary of terms. Material, having weight or meaning that is reasonably likely to influence making a decision or taking action. Non-public is information that has not been disseminated or is not available to investors in general. So people often claim that they have information that's coming from an insider. As a professional in the field, I think one of the things that a typical salesperson may do in the area of sell side and broker is the idea of, I heard from somebody that this is going to happen, and really what they're probably doing, in other words, the question you want to ask is it really true that this is inside information? They may say that it is, but is it? And I would say that in probably 99.9% of the time, it's not. It's people trying to show themselves as having some inside connection or something like that. But chances are very low that they're the first person to know this information, and there's been a breach. Because remember, information is inside the company, and at, let's say, the board level is the tightest controls, where board members are not supposed to speak on anything that's going on until it's publicly announced. So in order for that person to have inside information, that means the board member would have had to have told that person specifically. Now, they could have gotten it secondhand from another person. Let's say the daughter or son of that board member tells this salesperson, but it's highly unlikely that's going to happen. So the key to this standard is to understand material non-public information. I'll call it M&I from now on when I want to abbreviate it. So information is material if its disclosure would probably have an impact on the stock price. Investors would want to know the information before making an investment decision. In other words, it could be a game changer. Now, here are some examples. It could be earnings that haven't come out yet, or an M&A deal that hasn't come out yet, or new licenses, patents, trademarks that hasn't come out yet, changes in management, if it's significant, that haven't come out yet, bankruptcies, legal disputes, and on and on. Now, the less reliable a source, the less likely the information would be considered material. Factual information from a company insider could be material, but from an industry expert speculating on an outcome, no, that's not material. In fact, as an analyst, if you come up with something, and let's just say that you do your research and you come up with an idea that's exactly what's happening in the company, that is not inside information, and therefore you can trade on that. It may appear as though it's inside information when you go out and trade and say, this is what I think is going to happen, and the next day they announce it. But if you truly did it through honest research, then it's not an insider trading at all. Now, the information must also be non-public. So information is non-public until it's been disseminated or is available to the marketplace in general. When information is disseminated through media or press releases, then it's public. If you only publish to a select group of investors, then it's not public. So be careful with social media, because releasing information only there is not likely to be considered public disclosure. And this idea of a select group, imagine that you got together 10 of the fund managers who own, the majority of the shares in your company if you were a listed company, and you reveal to them something that is material non-public information. Well, have you disclosed it to the public? Well, you've disclosed it to your biggest shareholders for sure, but the fact is that that's not the public. So a small select group still is not, even though you're telling a group, it's not disclosure. So let's step through the can you trade on that information matrix that I've made just for fun. Carefully judge whether information is material and non-public. So the question is, can you trade on that information? If it is public and non-material? Can you? Public and non-material. The answer is yes. What about if it's public, but it's material? What do you say? The answer is yes. Now, what if it's non-public and non-material? Can you trade on it? The answer is yes. And finally, the only thing you cannot trade on is material non-public. Now, you may say, Andrew, that's interesting because what's happening when you're trading on, let's go back to non-public, non-material. If you get some information out of a company that's not made public, but it's not material, you could say you did your job as an analyst or a fund manager digging. So I want to tell you an experience of insider information that I had when I worked for a broker, and this happened in Indonesia. One Indonesian analyst thought that he was going to be rewarded for bringing inside information to a client. Basically, he met with a company and they gave him insider information. He went back to the office, did a conference call to one of the biggest clients who he knew had a sizable position in that stock and told that fund manager this information. After they got off the phone, very quickly, our brokerage was suspended. Trading was suspended between that fund management company and our broker for 6 months. That was the punishment that they had, and the analyst got in trouble. But the main thing about this was that why was it such a bad thing for the fund management company? They didn't go out and get this information. They weren't digging and they didn't act on the information when they got it. But why would they have such a high penalty? Well, you could say they're very ethical, but the real problem that they faced was that they had a sizable position in the stock and they wanted to add more. And so all of a sudden, when that analyst told them about this information, they had to stop all their purchases. So as long as they didn't have that information, they could continue. So when in possession of material non-public information, try to immediately achieve public dissemination. Now, if you receive this, make reasonable efforts to disseminate it to the public. Encourage the company to make the info public. It's not a case of you going out and making an announcement. You probably don't have the capability to make it a public dissemination like the companies do, where they announce it through the stock market and the like. Now, if public dissemination is not possible, then communicate only to your supervisor and compliance personnel within your firm. Most importantly, do not take action or alter current investment recommendations on the best basis of this info. So you had a buy, but now you realize it's a sell. Can't change it. Also, don't pressure insiders to privately share material non-public information. I have seen some cases when I was an analyst, I took fund managers to visit with companies, and some fund managers would push the company, particularly in the old days, to give them, something that everybody else didn't know. Most of the CEOs of the companies understood that that wouldn't be a good idea, and so they didn't do it. Now, I want to tell you my own experience with prop trading in Hong Kong. Now, proprietary or prop trading happens when a firm trades to profit with its own money. Now, managers know that prop trading can set up conflicts between earning profits for the firm and earning profits for the client. It also raises the chance of front-running client trades. So here's what happened when I visited the Hong Kong office of the large investment bank that I was working for. I went to the research department in Hong Kong to say hi to my friends there and to the sales department to talk to them. But as I was walking in the general area of the firm, a guy came up to me and he says, "You Andrew Stotts?" And I said, "Yeah." And he said, "I just want to thank you. You made the bank $20 million. And I was like, "How did I do that?" And he said, "Well, I run the prop desk. And when you upgraded," and this was the exact upgrade, it happened many years ago when I came into work at one of the brokers that I worked at, I upgraded the recommendation on Bangkok Bank from sell to buy. And I had been already doing a huge amount of work on that and had a buy recommendation at my last place. But when I did the research and published it and then upgraded at my new place, this guy took note and he immediately purchased it. Of course, he had to wait until all the clients could buy it. But after all the clients could buy it, he got compliance clearance and then he bought it. And he made $20 million out of that trade. And this, I like to tell this example because it tells you that, the company's much bigger than what you think. And there's people doing a lot of different stuff with information. And that's the reason why we use compliance and other centralized ways of communicating so that other people can know, and can communicate without the communication between that guy and me. So you want to encourage your firm to adopt compliance procedures to prevent the misuse of material non-public information. So compliance should review employee and proprietary trading, investment recommendations, documentation of firm procedures, supervision of interdepartmental communications, like in this case. And in this case, I didn't know there was anything going on. And so that meant that the compliance was working because he was executing the trade without any communication to me on it. So here's a guideline behavior of listed companies. Encourage your firm to develop and follow disclosure policies to disseminate fairly material non-public information. Give all analysts equal access and attention, and don't provide information to buy-side analysts like fund managers, but not to sell-side analysts or vice versa. And don't discriminate against an analyst who may be negative on your company. Also, considering issuing press releases prior to analyst meetings and conference calls. So you can say, well, we've announced everything, now you can talk about anything in that meeting. And, of course, ensure that those meetings stay on script. Now, if something is disclosed in an analyst meeting or a call that hasn't been previously disclosed, then the company just should promptly issue a press release or otherwise make the information publicly available. Now, let's talk about a firewall. Firewall is there to contain and prevent fires from spreading. Fire-rated boundary walls are required for buildings which are adjacently constructed, either within a minimum distance from the building's boundary or on the boundary itself. So here's a building. Can you spot the firewalls? Can you spot them? There's one, and there's another. The purpose of those walls is to prevent the fire from spreading. Of course, this fire could spread by ashes falling on the roof of the middle building, but it's not going to spread across the building because there's a wall in between. That's the concept of a firewall. That's where we get the words firewall that we use in the business. So you want to create a firewall as a barrier to prevent internal communications of material non-public information. The purpose is to restrict the flow of confidential information only to those who need to know. So what are the minimum elements? Well, critical information flows through compliance or legal before flowing to departments. And that's what happened at this Hong Kong prop trade, is that compliance, everything was going through compliance before things were happening. So compliance saw that I upgraded bank up bank from a sell to a buy, and compliance saw his desire to trade when it came up. And then review of employee trading. You want to maintain a watch, restricted, and a rumors list. You want to document procedures that limit the flow of info between departments and enforcement actions, and have a heightened review of restrictions of trading while a firm is in possession of material non-public information. It's actually really important when a firm has that information. You can't share it in any way, and you need to stop trading in that particular stock. Physically separate departments, personnel, and files to prevent the flow of sensitive info. Like investment banking and corporate finance should be separate from sales and research. And in fact, sales and research should also be separated. A bank's commercial lending department should be separated from its trusts and research department. And the general rule is that an employee should be on only one side of the firewall at a time. Now, there are times that people will go on both sides of the firewall, but if that happens, then from a research perspective, they can no longer publish their opinion. They just publish information about that company. So what do you think is the most common answer that you get when I ask people, why do you want to work in finance? What's your answer? Well, let's look at that for a second. What I have found is that people say, I want to get rich. I want big pay and big bonus. Well, if that's what you think you're going to do in finance, you may find that it's a problem. And the reason why is because you really want to focus on making money for your clients, not yourself. And if you're so set on making money for yourself, the client and other employees may feel that, and it may not be a great way to exist in the business. But more importantly, is that you may think that you can trade on things that in fact you can't. So that's why we're going to talk about this idea of limit personal trading of employees. Firms should consider restrictions or prohibitions on personal trading by employees. In the case of Citibank, when I worked there, they would not let, I covered the banking sector, they would not let me buy any bank stocks that I covered. And carefully monitor both prop trading and personal trading by employees. Firms should require employees to make periodic reports of transactions made by them or their families. So, what to do when a firm has or may have material non-public information? Securities should be placed on a restricted list when a firm has or may have non-public information, material non-public information. You want to avoid broad distribution of a restricted list so it doesn't trigger trading. You don't want people to see in the company that you're restricting certain stocks, and that's the reason why you don't see the restricted list very often. That's maintained at a higher level usually. So let's look at a restricted list. Securities that are restricted from purchase or sale by employee or client accounts. Remember, you can't let clients trade on this or else people are going to think that you're letting that information out. It could trigger reporting or regulatory issues, and it could be in possession of material non-public information, could be involved in a corporate transaction. These are some of the reasons why you would put something onto a restricted list. What about a watch list? Well, securities that do not have trading restrictions but are subject to close scrutiny by compliance, dissemination should be limited. Now, the use of a watch list in combination with a restricted list is an increasingly common means of ensuring effective control of personal trading. Now, the mosaic theory uses bits of public and non-material information. Ultimately, the job of an analyst is to try to put the pieces together until we end up with something meaningful. When financial analysts make conclusions derived from the analysis of public and non-material, non-public information as the basis for investment recommendations. That's the concept of mosaic theory. In this case, you're free to act on those conclusions even if they can be material. In other words, you could come up with a material conclusion that wasn't derived from insider information. Now let's look at some questions I have for you. What if you found out that a company you covered as an analyst has falsified its financial statements? After you do thorough research, you determine that management may have misstated profits by as much as 40%. Well, here are some questions to think about. Is it material? Well, the 40% kind of gave it away. That's pretty material. Is it non-public? Yes. Are you an insider? Well, if you're an analyst covering a company, you're not an insider. An insider may share information with you, but in this case, you're not an insider in this particular case. You're just observing. So if material, even if you're not an insider, if material, you should make reasonable efforts to achieve public dissemination. This can be done by encouraging the company to make the information public. What should an analyst do if they suspect that a company has falsified its financial results? Well, perform a thorough analysis using information from multiple sources. So this is before you get to a point that you've concluded that you think it's false. You just have a suspicion. So you need to do some work there to try to figure that out. Maybe go to multiple sources to try to find information, call, look at other sources. And then you need to be independent, right? Don't look for confirmation from others. If after diligent effort you remain concerned, then report your concerns to your supervisor or compliance officer. Don't get into the bandwagon effect. Just because everybody's following that particular stock or that particular recommendation doesn't mean that they're right. And communication. You want to communicate to clients after reasonable efforts, not just on rumors or suspicions, and discuss with a supervisor. So you only communicate, of course, after you've had your communication with your supervisor in your company. Now, what should an analyst do if it gets inside information that could change a buy to a sell? Well, of course, the analyst wants to act on it and get his clients out of the stock. I'll be the first one to get everybody out. That's the way they'll feel. But if the information is material and non-public information, then You should not use it in any report until it's released publicly. In fact, you also should not cause anybody to trade on it. And you should attempt to get the company to publicly release. So this is a little bit of, can be a tricky question, because when you find material non-public information that makes you want to go from a buy to a sell, you could say, well, my loyalty is to my client, therefore I should tell my client. No, insider trading is a much bigger issue. It's not just about you and your client. It's about the whole market, and it's about the law. And therefore, you need to not take any action until that information comes out. All right, I got a question for you. Want to be famous? I've got a quick way that you can get there. Insider trading. Here are some high-profile cases of allegations of insider trading. And you don't want to get famous this way, but it's a fast way to get famous, and you'll get a lot of publicity. Now, these cases are at various stages, from allegations, just allegations, to convictions. And I won't necessarily know the updated details of each case, so some might be able to prove in court that they were innocent. Some will not go to court but just pay a penalty, and therefore I'm not claiming that any of these cases are either guilty or innocent. I'm just asking you to consider them for information purposes only. So meet Darina Windsor, who has been charged in a serial international insider trading scheme. And she's a native of Thailand, was involved in a global insider trading ring. She worked as an investment banker and was implicated in leaking confidential information about pending mergers and acquisitions to co-conspirators. So there you go. You think, I'm going to get a job in M&A, and I'm going to get so much information, and maybe I'll just do some trades or tell my friends. Don't do it. So Windsor was part of an international network that included other financial professionals, and the ring obtained sensitive, non-public information about mergers and acquisitions and used this information to execute profitable trades ahead of public announcements. Windsor was arrested in the UK in connection with a similar investigation before being charged in the US. According to US authorities, Windsor, along with her associates, made significant profits from these illegal trades. Now, the US Justice Department and the US SEC charged her as part of a broader crackdown on insider trading activities. As of the last reports that I could find, Windsor seems to be at large in Thailand. Her involvement in the case highlights the international nature of insider trading networks and complexity involved in prosecuting such cases across different jurisdictions. Now, you could just imagine how this happened. Basically, maybe she or someone else came upon insider information, and they decided, I'm going to share it to my friend on WhatsApp, and I'm just going to say, buy stock ABC. I think it's a good idea right now. And then your friend goes and trades on it and then makes a lot of money on it. So basically, what the regulators are doing is they're looking for unusual trading volume before an announcement, and that's where they try to dig down. And they may look at your friend's account, right, if you did that, and they would try to figure out, where is this information coming from? Now let's look at another one, Martha Stewart. This one, is fascinating because it raises a question of, okay, let's say that a company, let's say a company director tells a person that they tell them inside information about a significant event, and that person tells another person, and that other person doesn't really know, is it significant or not? But they trade on it. Are they in trouble? Well, here you can see. This Martha Stewart is a famous lifestyle guru. She was convicted in 2004 of insider trading. And she sold her shares in a company named Imclone Systems based on a tip from her broker, avoiding a significant loss when the stock price fell. Stewart ended up serving 5 months in prison. So that's an exact example where an insider leaked something to somebody who told another person, and that person, and you couldn't say Martha Stewart doesn't have any idea about, is this material or not, but she knew enough to say, I want to get out. So maybe she did know that it was material. She may not have known that it wasn't public. Maybe she's just super busy. But this is a great example that even if you don't know and you're super busy, you still could get in trouble. Rajaratnam was the founder of Galleon Group hedge fund, was arrested in 2009 and later convicted in 2011 for insider trading. And he was found guilty of using insider info to make over $60 million in illicit gains. And the judge hit him with a $150 million civil penalty. I didn't, when I was an analyst back at this time, I never called on Galleon, but I can recall seeing their name in our list of clients at the different brokers that I worked at. Of course, that doesn't mean that my people were giving inside information, but I just remember that. So Rajaratnam was sentenced to 11 years in prison, one of the longest sentences ever for insider trading. And he was released in 2019 after serving 7.5 years. You want to be famous? You can see he's very famous right there. That's a famous picture of him being handcuffed. What about Rajat Gupta? He was a former director at Goldman Sachs and Procter & Gamble, and he was convicted in 2012 of leaking confidential information about Goldman Sachs to Raj of the Galleon Group. And Gupta provided Rajaratnam with insider information about Goldman Sachs' earnings and investments by Warren Buffett's Berkshire Hathaway during the 2008 crisis. So Goldman Sachs was at risk of going bust, and they did two things. First, they converted into becoming a commercial bank so they could get protection from the government for their deposits. It's a very sneaky thing, and I think, truthfully, I don't think that they should have been allowed to do that, but they were. But the other thing they did is they got Warren Buffett to take a big stake in them, and they knew that that would be a huge boost to the share price, and that's Gupta was sentenced to 2 years in prison. Another guy, Scott London, again, famous. He's a former partner at KPMG and was convicted in 2014 for insider trading. So here you are. You're going to be an accountant, let's say, and you're working for a big, four. You're going to get a lot of inside information. You're going to see a lot. Well, he leaked that non-public information about the KPMG's audit clients, including Herbalife and Skechers, to his friend Brian Shaw, who then traded on the information and made significant profits. Now, some people will say, well, I didn't benefit from that. Brian Shaw did, right? Well, first, the SEC and the government is going to look for connections of how you benefited, but they don't care that you didn't benefit. That's not a defense. London was sentenced to 14 months in prison. Now, in Thailand, we have a case of Prasert Tong Osoth. And Prasert was a well-known Thai businessman, primarily known for his involvement in healthcare sector as founder of BDMS, one of the largest hospital operators in Thailand. And in 2018, Prasert and his associates were fined by the Thai SEC for engaging in insider information. They were found to have used confidential information to trade shares of Bangkok Airways, a company in which they had significant interests. The total fines amounted to approximately 500 million baht, which is about $16 million US. The case was significant as it demonstrated the SEC's commitment to enforcing securities laws and penalizing even the most influential figures in the business community. Then there's Pete Bodaramik, and he's a prominent Thai businessman known for his role as CEO of Jasmine International, a telecoms communication company. And when I was an analyst, I used to go see Pete on a couple of occasions when he was launching 3BB, his broadband system that he developed, or broadband company that he developed. He was fined by the Thai SEC for insider trading related to his dealings with Jasmine, and the SEC found that he had used non-public information to trade shares in a manner that benefited him financially. So, you want to be famous? You don't want to be famous in this way. Be famous by being ethical. So best practices to comply with Standard 2A. First, encourage public dissemination after receiving material information. Do not trade or cause others to trade on it. And establish firewalls by restricting the flow of information to a limited number of people. Have physical separation between departments and prevent personnel overlap between different departments. So let's fill in our cheat sheet. Pause the video and type in "don't act or cause others to act" on material non-public information. Well, congratulations, you've made it to the end of this section. Next, we're going to go through a pump and dump scheme. I'll see you there.